Welcome to the Private Lenders Podcast with your host from Hard Money Bankers, Jason Balin and Chris Haddon. This podcast is sponsored by hardmoneymastermind.com.
Welcome back to the Private Lenders Podcast. I'm Jason Balin from Hard Money Bankers. And with me live from Charleston, South Carolina, Kelly Garrett and Angela Dunn from Rehab Wallet. Welcome, ladies. Thanks for joining me today on the show.
Hey, Jason.
Of course.
Absolutely. So real quick, before we get started, I love the Rehab Wallet name. I love the Rehab Wallet graphics and design. Like, whose idea was it for that name, first off? And who did all the graphic design? Because you guys have obviously very, very good branding.
Not yours. No, neither one of ours. We hey guys, my name is Kelly Garrett. I'm one of the co-founders of Rehab Wallet. Well, I have two other partners, and one of them has a marketing brain, marketing genius. We pay a little money for it, but you know, we searched, wanted to have a certain name, and it fits, and we just have a really strong marketing side because it's the strength of one of the partners.
Absolutely. Yeah. So why don't we just start with, you know, a little bit of background of you, Kelly, and you, Angela, and, you know, how Rehab Wallet came to be.
Well, I'll start. We, you know, 2020, June of 2020, right in the middle of COVID, you know, who starts a business during that time, but crazy us, but we did. That again, like I said, I'm one of the co-founders. There's two other partners, Danny Randazzo and Dan Hanford. They own a company called, another wonderful name, passiveinvesting.com. They, you know, a PE firm that private equity that has a multifamily division, storage, car wash. What am I missing? Hotel, and then now a lending arm. So on the lending arm is what I'm a partner in and deal with on a day-to-day basis. But Danny and I are great friends. We just, you know, have always been friends for, I guess, since 2000, not always, but since 2018. And we meet on a weekly basis and kind of chat, talk, dream. You know, we're both entrepreneurs. And on a walk one day, and he was saying, you know, I was doing some private lending, and he was like, how's it going on the private lending side? And I said, it's going great, but I'm out of money. I mean, the phone's ringing, but I'm out of money. And so they are amazing capital raisers and marketers. So through that walk kind of came up with the idea of us starting a debt fund. And, you know, we kind of just break it out. All three of us have our own little areas of specialty. And mine was, I said, hey, I'll build the team out and we'll put the money on the street if y'all can raise it and deal with the marketing side. And so that's what happened in June of 2020. Now we've raised a little over 140 million. Mm-hmm. And we'll do 300. We've done 330 million so far in loans in 4 years. So we're off to the races on a pretty good start. But Angie and I, this girl right here, we been friends since we've been 15. Angie, I'll let you introduce yourself so I don't have to talk about it.
All right. My name's Angela Dunn. I'm the managing director at Rehab Wallet. And Kelly shared that her and Danny have known each other since about 2018. Kelly and I have known each other since the 1980s. We'll just leave it at that.
Yep.
But have been teammates now on 3 different teams, with Rehab Wallet for sure being the most exciting, the most lucrative, and at times the most challenging. But this has been a lot of fun and a lot of learning experiences building out the Rehab Wallet team as the managing director.
Yeah, Angela and I played ball together at the College of Charleston. And prior, when we were kids, played AAU ball together. So just been good friends for a long time. When she got done of her career, almost 30-year career, I wasn't retired yet, so I didn't want her to be retired. So I was like, hey, come on board. And we just have a lot of fun every day. And it's been great having her around for the last, 6 years now?
Yeah.
6 years.
But that's what it's all about. So I got to ask, related to, you know, I think some people watching and listening, they were like, whoa, you guys raised $140 million. That's so much money. Is that primarily kind of one-off investors that have, $50 or $100,000, or is that bigger investors that have millions and millions and millions of dollars?
It's 150,000 at a time, 100,000 at a time. Our minimum investment is 25,000. So it's a lot of investors. We probably have one investor that has over 3 million with us. Other than that, it's just little chunks at a time. It's a lot of hard work.
Yeah, no, I think that's a good piece of advice, and that's kind of similar to our portfolio. Although, we obviously, we have a few investors, that are in the seven figures. There's just a lot of capital investors that have, a few $100,000, and they start with you, and you show them good results, and they continue, and then they tell their friends, and they tell their family, and
exactly right.
Happen overnight, but it does happen.
That's right.
Absolutely.
It does happen. What's kind of been the hardest thing kind of in your journey? Has it been, raising the money or finding loans and finding deals?
I think at different times it moves, right? Because this is a balancing act. So one month it might be deals, and the next month it might be money or capital. But I would have to say, up until recently, it's been about capital, and now pendulum has switched, and now we're flush with capital, and we got some work to do over here on the borrower side.
Yeah. It's funny how that goes. Funny how that goes, and I think a lot of newer hard money lenders or private lenders don't really see it that way. I've always heard the term like, oh man, if I just had all this money, all this capital, everything else would work itself out. I have all these deals, and it's just like, well, you might have more quote unquote leads, deals calling you. That doesn't necessarily mean they're going to be real opportunities and real deals. And, when we started, we didn't have that much of our own capital. And, I always thought the same thing. It's like, oh, we just had all this capital. It won't be a problem. And I remember going to capital meetings, 17, 18 years ago and, talking to them and telling them, hey, this is our business. This is how we operate. And they're like, yeah, that sounds great. I can get this rate of return, first mortgage secured by this real estate, like no brainer type of thing. Go find me the deals. And then that's where the hard part came. Like, yeah. Okay, well, where do I find all these deals?
Yep. I mean, we work really hard on both sides and constantly out there in meetups and real estate investment groups. I personally own one here in Charleston that has 70, 80 people at it every single month, where, we take our booths and, show up in all of our gear and just let everyone. So that's kind of the old school way. And then the marketing way, we just, every single day we're putting something out on social or email marketing campaigns or something. So it's a job, but it's according to how you want to scale. If you're private lending with $1 million, it'll go in 3 loans. But the more money you have, obviously becomes a challenging over on the borrower side.
The relationship building for sure is I've observed Kelly replicate and teach me and the rest of the team how to build it. I would really emphasize that relationship part of it, whether it's on the capital raise side or the lending side, because that is the foundation for sure.
What was the first 3 months, 1 to 3 months of your operation? Like getting started? Did you go out and start hiring everybody at the beginning? No. Did you just run everything yourself? Like what were you focused on? Like, I always think that's an interesting story.
Gosh, that's a great question. Mm-hmm. Great question. We originator. Then I brought in a processor. So I brought in but she had no experience as a processor. She just had a processing brain. She's just an IT, software development type of experience. And we had to train her on real estate and putting all the processes in place. We're a startup, just like everybody else is a startup on month 1, month 6. So we did one loan in June of 2020, $153,000 in Charleston, South Carolina. And I kind of was already doing that on my private lending side. So I just said, hey, let's practice with this one. We had a checklist, paper checklist. So we were just checking stuff off. We had to move all that. So we did a lot of stuff the old school way. It's kind of my personality. And I hate to say it kind of goes with the culture of who the person is. Of spreadsheets. We didn't have software at the beginning. None of that. So then maybe after month 6, we got the software and started moving everything over to Mortgage Automator and using a piece of software. But it was literally like, because my personality is go out and let's go do it and go score. And so we started scoring in month 2. And then we ran out of money in month 5. So we started in June. In November, we were using partner money at the beginning because I also didn't want to bring in investors yet till we had a proof of concept. I just didn't feel like it was prudent, right? And being a good steward of investor money, I wanted to make sure the partnership was going to work. As much as I loved my partners, I thought I did. I especially knew Danny a lot more than I knew Dan. I wanted to make sure this partnership would work before I bring investors into this family. And so about month 6 or month 5, I'm like, this is a proof of this is going somewhere. And so then we started raising money. So we used our own personal money at the beginning. And in month 5, we ran out. So month 6, we started. So in December, we did 0 loans. But I think the first 4 months from June to November, we did 11 million.
And most of that heavy lifting, or most of the stuff was kind of outbound, just trying to get deals in the door. Like, let's get deals in the door and try to figure out where to go from there.
Correct. Yes, exactly. It was all about that. Okay, we got this loan. Yay. Let's practice on this. Let's see if we can process it, do our paperwork, and do our documents correctly. Everything was in our backyard. It didn't go anywhere except our backyard.
And the demand was there. That's why we ran out of capital. Once the people in Kelly's network that she had done private lending, once that word spread, the demand for sure exceeded supply. And for the most part, in our 4 years, it has been that scenario.
What percent or approximate percent of your borrowers are repeat at this point?
85%. We've maintained that for almost 2.5+ years. So when we get a borrower in our web, so to speak, I think the service level and our business model, because again, part of it's relationship, but we have a really seamless draw process.
Yeah, I see. We use Teams as a chat and a communication tool, and so I'll watch it sometimes and see them, and then I'll see Ange just take a picture of socks on the ground, and I'm like, what in the world is she doing, right? And it literally is and then a little quote at the bottom, it says, y'all just knocked the socks off this customer because they got a testimonial from that person. So literally that's her culture that she brings and always has been, that the time that I've known her, which is a long time, is that the customer service, we're going to knock their socks off. We're going to knock them off. And the culture that we bring to that. And then the other culture of go and score some points and get borrowers in and a lot of capital kind of is what I bring. And it just works. Now you got to embrace both of those so you don't overload the process with loans. So, you got to kind of keep that governor on everything.
And I think recently you and I actually had a conversation around that, because with this really exciting but challenging influx of capital that we've experienced during the month of July, it did put some demands on our team. And there was a conversation that Kelly and I had, and this is where just the relationship and the level of trust that our entire team has is what sustains our business model. And that is, we use basketball analogy so much because Kelly and I say we're bilingual, but the second language is just what we speak on the basketball court. But you can only full court press for so long,
right,
before you completely run out of steam. And I saw that about to happen with our team. And in some cases, had to take some extra water breaks. And I realize those analogies don't always translate. But we're in a real good position, and it's very exciting to have this level of capital.
I love that. I love the analogies. I think they all make a lot of sense. And we kind of we inside our business, we call it like we have different seasons in our business. Sometimes we're at like a growth scale. Sometimes we're at optimization scale where it's like, hey, like we're all very well staffed. We could do, we could keep growing. And then you get to the point where it's like, wow, like we've had a lot of growth. We need to go rewind a little bit and make sure all these pieces are seamless. Right. And everything's back in place. So I agree. Like in that, and at your amount of growth, over the years, like it happens quickly, right? Like you get to a point, and this could happen month over month. 1 month you could have this bang up month, and you're like, oh wow, like we need to make sure we have different things in place. And I think that's challenging for a lot of entrepreneurs and a lot of private lenders as well, because there's no playbook. Right? We're all kind of figuring out what we want, right? Like there's a lot of successful private lenders and hard money lenders that I know that have a few $1 million of their own capital deployed. And they have a very good, their top line and bottom line revenue is about the same, right? They don't have much overhead, and, they can make good money. And, on the other side, you have a big built out operation and machine, and that works too. So it's whatever you kind of, however you kind of want to play it. I think there's no right or wrong. Another thing you touched on is the importance of customer service. And I do agree with that, because that's not something that's usually it's not really a word that's talked a lot about in the hard money lending industry. Typically the different people you see are kind of the old school banker types where I have the money, I make the rules, right? There's like that type of person. Yeah. And then there's kind of the newer school sales hustler. Hey, I'm just trying to grow and do as many deals as I can. And they're a yes man. And they're just like, hey, let's just do it. Yeah, cool. We'll make it work. And whatever. So, but the point is I think we've been very good with customer service internally inside our personal business as well. And we've definitely learned from some of the stuff that you guys are doing, because that goes a long way. And the goal of this business is to have repeat borrowers. 85% is great, obviously, repeat business, because we all know that doing your second and third or 10th deal for a borrower is significantly easier than the first. Significantly less marketing expenses, less risk. So that's the goal. Churning one-off deals over and over and over is hard work, right? So the goal for anybody watching or listening is, I usually say that it's 50-50, right? About 50-50, right? So, every 2 loans you do, you're going to get you're going to get another one. So you're going to get a third loan in, and, strive for something like that, because I'm sure you guys can attest that your repeat borrowers make your life a lot easier, and you just have to maintain them. And again, close on time, make sure they're getting their draw requests on time, providing them value, assuming they're performing loans, right? And they're making their monthly payments.
Yeah, we wanted to, we had a goal initially of 50%. And I think that's a takeaway is just set a goal of what you want to pursue, and then see if you just can't blow through it, because it is so much easier. I mean, preparing your docs to the relationship, and you already know how he or she, gets the docs into you quickly, and how they just know everything about your system already. So much easier.
So much easier. So I know you guys originally started with mostly, fix and flip real estate investors. They come to you to borrow money for acquisition money and rehab funds. Has that expanded into other types of stuff at this point?
It has. It's expanded a little bit. We're probably 5%, not much more than that. 5% of our fund is in some type of commercial or multifamily or something like that. It's not significant. Our bread and butter and our avatar is fix and flip. Sub 200,000.
Sub 200,000. And what's your median housing price in, let's just say, Charleston?
It varies from North Charleston to coming across to the water in Mount Pleasant, but median price I'd say is in the 300s.
Yeah. So 200,000 is the right number. And are these some of these investors holding these as rental properties as well?
About 80-20. And obviously, when interest rates got a little more challenging, some of them their exit strategy pivoted and they sold them, but it probably stays pretty close to that balance.
Yeah. And when you originally started, what was kind of the goal for the business? You know, I don't know if you had a size wise or volume wise, or was the play to, you know, to exit or to keep this as a wealth building machine? You might not even have an answer. You might not know because it, you know, like all of us, our goals change on a regular basis.
Yeah, I think year one we had no idea. In year one, we did that 11 million. So the next year, we're Angel's great at this. Big forecaster, big planners, and that kind of thing. So we planned 50 million that next year. And then we were able to see that. And the next year was 100 million. We came a little bit short, I think at 97 million. And then this year's 125 million. So we knew that we you know, we don't go from 11 million to 100 million. We kind of we felt and budgeted and kind of forecasted out what we thought we could do. And answer your question about the exit, you know, that's always that I bought and built and sold now 8 businesses. So that's always in our thoughts. But when you can cash flow a business like this, like all of our lending companies, right? Yours, mine, and anybody in this network, it cash flows so well. Why would you sell it?
Yep.
Is where we're at right now. Why would we sell it? You know, then you have to ask your questions like, what would happen if your investors, like Jason, if your investors are coming in, a lot of them probably because of you, right? And your team. And so what would happen to them? Would they just bail out of the fund if we did? So we have a question mark over my head because I don't know what would happen to our investors if we were to like sell it to someone else, a big institution. And then the other question is, why would we sell? Because we cash so well.
Yeah, I get that question from a lot of hard money lenders across the country that have like, you know, decent sized portfolios. They're like, are these sellable businesses? And it's something that's crossed my mind a lot. And I, you know, and my business partner, Chris, and I talk about it a lot. And it's kind of like, not that the answer is no, but or yes, it's like, but why? Like, let's do the math. Let's play through it. Like, does it make sense to do so? And it's also, let's be honest, like it's a pretty good feeling when you can give a private capital investor in your fund or in your network a high rate of return with low risk. And then you can have a good cash flowing business as well, right? There's a lot of players involved that you're helping. You're helping borrowers, you're helping vendors, you're helping employees. Like it's a win-win-win-win-win-win-win. You know,
I think about this a lot because I'm 20 years older than Dan and Danny. And so I have to consider what would happen. And so as an owner or a founder inside a company, the equity, there's the 3 equity partners inside this business. What would we do? Maybe they would buy out my shares, or something like that. So I do think about that sometimes just because of the difference in age of the partners. But
sure.
Right now, we're going at it, having fun, and making some money along the way.
No doubt.
We got math
heads. Go ahead. Sorry.
We got a lot of math heads out there. Just because Kelly's 20 years older than those other 2 partners, that does not make me 20 years older than those other 2 partners.
Maybe even.
Hey, for people that don't know those partners, they don't know how old they are either. So, those guys can be 20 years old. Those guys can be 20 years old each.
Exactly. They are.
Another question related to, and you might not know the answer to this because you might not have gone down this road yet. So you guys have a debt fund. There's a lot of different ways to raise capital for this space. You guys have a debt fund. Our business model is all direct placement, where in essence we have capital investors that are co-lending with us. We close them under our name. Say it's $100,000 loan. We fund it out of pocket, and then we assign it, sell it, whatever, and then we retain servicing. Other lenders in this space sometimes just take unsecured debt from their capital investors. Some have leverage pieces and assign them to banks and things like that. Do you guys like the debt fund? Is that something that you would recommend for other hard money lenders? Is there maybe some pros and some cons? And if you had to start over again, would this be the same way you'd set it up?
When we joined your mastermind, we didn't know any better. We just know what we know. right? And so then we get with your peeps, and they do it like you do it. Most of them, most everybody in the group does it like you do. The placements. And so I wouldn't do it any other way, because it's work for us. And this open fund helped. Like every day, money's coming in, and obviously money's going out, because we also let them. Inside our fund, we have a 90-day liquidity option. So let's say somebody's like wants to put money in January and then pulls it out in December for taxes or something. We allow that liquidity option as well. And so, and also inside our fund, we let our investors compound. And so you don't have to, very little, 22% of our borrowers, our investors take a distribution monthly. Everybody else lets it stay in, and it compounds. So they're making more than the 8-9% of that actually is that they start with. So I wouldn't do any different. Is it hard juggling that? Yes. But again, we've built a team around it. You asked me early on, like how we started. We started with, one employee, and Angie and I were originating. And, but then year 2, we hired the next person, and now we have a team of 9 people, and around us. And that's the way I like to run the business. I don't want to be it's not her superpower. It's not what we should be doing every day. We should be out, developing them, and should be developing our team. And then my job, and actually hers too, is just out constantly marketing and constantly talking about Rehab Wallet, and constantly talking about what today am I going to do to increase revenue and decrease expenses and all the business. And
it's fun. It's fun to do that. Part of building a team is identifying what is each person good at, what are they interested in learning, and what do they not like doing, and how can they fulfill a role on this team to make us even more successful. So that's part of the puzzle also.
Yeah. I'm going to repeat that last part. Every day you're out there figuring out ways to increase revenue and decrease expenses. I think that's a very good, a very good line that I think some people don't fully grasp. Before I give you guys a chance to, share your contact information, stuff like that, is there anything else that I missed that you want to share with the group?
I know I've enjoyed being a part of your mastermind.
Super helpful.
I appreciate, there's easily been 15, 20 times I've emailed you with the question, how responsive you've been, and just the relationships that our team has been able to build through your mastermind. That's helped make us even more successful.
We all need to, all of us, everybody needs to be, trainable and not think that we know everything. We have a decent sized fund. I feel like we have a great team and a lot of very smart partners involved. Not me included, but 2 very, very smart partners. However, you guys have been in the business 16, 17 years, and with experience comes a lot of knowledge that we wanted to tap into. And, I still was looking at, actually this past week, I was looking at some notes that I did on the first mastermind we were at. I was writing notes crazy. I was asking things like, have you guys ever been sued? You've been in the business long enough that things could happen. I wanted to know, like, what happens when you stay in this thing long periods of time, because that's what we plan on doing. That's just very, very important. Very important. So we appreciate all your guidance and on both sides.
Absolutely. And everything happens when you're in this business long enough. Everything. We just saw a case of a deal where we were supposed to go to we were doing 2 loans for this particular borrower. He was supposed to show up at the title company, never showed up at the title company. We were trying to get a hold of him. He had gotten arrested literally like on his way to the title company for something pretty bad and malicious, and kidnapping that, he kidnapped some people, like, and then they, I don't know, long story, but like, you never know. And so on our end, it's like, that's ridiculous. Thank God that, dude gets arrested. We never did a loan for him. What can we do to tighten up the process? So something like that happens. And sometimes it's not, sometimes you can't do anything. In this particular case, it's like, well, you know what? Maybe we should have Googled his name a little bit more. We don't have background checks that we do on every single one of our deals. Even though some lenders do, some lenders don't. So we decided after that, you know what? Anyone who has, a certain credit score lower, maybe we should do a background check. Another quick example. We just did a few loans for a real estate investor that owns millions and millions of free and clear real estate. And we did several loans for him, over $1 million worth of loans. He defaulted on his first payment. This is 45 days ago, right? This is new to us, right? Things that like hadn't happened before. He defaulted on his first payment. Somebody that defaults on their first payment is a no-no. So we're like, you know what? Maybe on all of our loans over $1 million, we should do a background check as well. Since then, we got the monthly payments in. We harassed the guy enough to make sure, be like, you can't default on your first payment. That's not a good look, dude. So anyways, point being is new things are constantly happening to all of us. And I think it's good that we can all kind of adapt in real time and figure out not necessarily solutions, but way to fix some of those things, because I don't want to say that I've seen it all in this business, because I haven't. I've seen a lot. That doesn't mean that I'm, better than anyone. I've just been around it long enough that things happen. You do enough deals, like crap happens. We've had borrowers that have died. We've had borrowers that got hit by buses. We've got borrowers that leave the country. We had a borrower, we did 60 loans for him. 59 of them went out perfect. His 60th, he lost money on, and he bailed and he left the country. Like, how do you protect by that? I don't know. Things happen.
I mean, we've had something recently. We've been through already a bankruptcy and then a title claim. Yep. I've been in the business almost 30 years now, like buying and selling real estate, as a real estate investor, and of course now a lender. I have never dealt with a title claim yet. So the whole team was, I'm sure, looking at me like, what I do? I don't know. Let's go through the process. And that is a long, drug out process that is very, very interesting. Especially we got downtown Charleston. That Charleston's been around a long, long time, and heirs properties comes into play with all that. And you find 16 heirs, and you got to go locate them, and it drags on a year and a half before you get paid. And our borrower's not making their payment because they think that they're going to lose it back to the heirs. So anyway, it's been super interesting, but it's helpful having the group
sure.
to email back and say, hey, have you guys dealt with this problem yet? And if so, what?
Yeah, and typically somebody probably has. And title claims is a good one because it's a unique situation. Sometimes the title claim is the title company just tries to, insure your first position, and that's the whole claim. A lot of the times we file title claims and we have very little. And the good part is, if it works out great, we have very little legal fees because the title insurance company assigns us a title agent or, an attorney, and they cover it. So that's good as well. Another tip or hack, and I think you guys probably are implementing this. If you're not, it's something to consider if your state allows it, is to have, 120% title insurance, because that exact same situation is when you got paid out on your title claim, you're only going to get back your amount, your principal amount, right? If it's a $100,000 loan and you have 100% policy, they're going to pay out $100,000. If you had 120% policy, they could potentially pay out $120,000, and that could cover late fees, interest for capital investors and things like that. And that was something that we learned as well, because we had a title claim that also took 2 years and we got our capital back. That was it. We didn't get any return to the investor group. So we started putting 120% title insurance premiums in place. And most of the title insurers and most of the states will allow it. And it's only a few extra bucks on the front end. And we do that in almost every deal to kind of hedge it. And, we get paid out more. So just little things that you learn along the way. So Ange, Kelly, I certainly appreciate you guys taking the time. Real quick, just tell everybody how they can find Rehab Wallet, either phone number, email address, website. I know you guys are doing like some really good things in Charleston and some other markets. Somebody might feel, might want to reach out because they need capital or they want to invest capital, or just kind of pick your brains.
Yeah, we're just not in Charleston. We're mostly in South Carolina, North Carolina, Georgia. I would say the Sun Belt, but we're not in a lot of deals in Florida at all. And in Ohio, Tennessee, Virginia, Ohio, weirdly. We'll go with the borrowers, right? If it's an experienced borrower and we like the deal. How to find us, of course, rehabwallet.com. Tons of information there. There's a tab there that says borrow and a tab there that says invest. Whichever one you might be interested in. Or if you need to email us for anything, it's info@rehabwallet.com. Or just put our names up there. Kelly, Kelli, @rehabwallet.com.
And Angela, Angela at rehabwallet.com.
Yep.
That's great. I certainly appreciate you guys coming on here. This has been great. I certainly appreciate it.
Thank you so much, Jason.
Talk to you later.
All right.
Take care. Thanks.
Bye.
We hope you enjoyed this episode of the Private Lenders Podcast. Please note that the opinions stated by all the speakers on this show are only opinions and not intended for legal, financial, or accounting advice. Please make sure to always check with your own legal, accounting, and financial professionals. If you enjoyed this episode of the Private Lenders Podcast, we'd appreciate it if you would spread the word. Make sure to check out hardmoneymastermind.com, the #1 free community for new and experienced private and hard money lenders.